Good afternoon and welcome to HYCM's online trading workshop with myself, Giles Cochran, the Chief Currency Analyst here at HYCM. I hope everyone's doing well. I'm just going to say hello to folks as you're coming in. Okay, hi John, Olufemi, Rida, Sami, Sajai, Blessing, Van, good to have you on board, guys. Looking forward to this coming week. Rosemary, hello, nice to have you with us for this session. As I'm coming on, would you just let me know that you can hear? Hi, Sammy. I assume that the screen and the sound is coming through okay. I hope that's working all right for you guys. That's super. Just as we're coming on, remember that the whole idea of this workshop is all about education. It's all about how to understand the FX markets for yourselves, so you can make trading decisions for yourselves as we're going through different currency pairs, looking at different entries, stops, exits. The idea of this is not that it's a signal service. It's not that I'm providing signals for you to copy. The whole idea of this is it's all about education. So you look at the things I'm looking at in order for you to make your own decisions. So you can make your own trading decisions for yourselves, and over time you don't need someone like me because you just understand how the market is moving, and you get to recognize it for yourself. As we're going into the session, just to let you know, don't forget to use the question and answer panel during the course of the session. If you have any questions you want to ask, just put the question in there, and I will try to answer the questions as we go along, or possibly have a look at the end and just sort of tidy up everything that's happening at the end of the session. The special topic that we're looking at today, and it's a really important topic. This is the importance of trading fresh news when trading sentiment. I just wanted to go through probably the most straightforward way of making money in the FX markets is trading these fresh sentiment shifts. So just wanted to look at that in a little bit of detail to give us a bit of a heads up on when a market is quiet, it's easy to want to force trades. I remember as FX traders, our job is not to trade, but our job is to make money. So it's not that we have to be in a trade every single day. We just need to make money from trading. So there's a distinction between those two, and it can be easy just to get stuck in a rut, and every day you're looking for a trade. You want to set your orders. You want to put something in the market. You want to be in the market, and that can mean we'll take some standard trades. So this topic is just the old emphasis is how to spot those high probability fresh sentiment changes, because those fresh sentiment changes offer some of the highest probability of trades that we have. When you're in on that trade, as the sentiment is changing, that's when you're getting the most high probability trades. So we'll spend some time looking at that. The handout for the session is in the usual place. If you go to your handout section underneath the handouts on your GoToWebinar control panel, there's a little triangle pointing towards handouts. It says 1 of 5, and if you click on that, you get a workshop guide that looks like this. You can see the special topic we're looking at there. And then, as I've said to a number of you guys, this is 5 principles that I apply to the markets every time that I'm trading. I'm wanting to look back, look forward, look at the charts, look at your risk, and then look at the outcome of your trade. Okay, so we're going to do those 5 different topics, and this handout is the idea is you print it out, put it by your desk, and it just works as a guide for you when you come to make your own trading decisions. Any topics you'd like to have covered during this session, please email me to giles.cochran@hycm.com. I can then have a look at some of the different topics that are being suggested, And if there's something you really want covered, email it to me there, and I will try to have a look and cover that topic for you in future weeks. Just as we're getting on, I want to make it clear that each time we're coming to trade, what we really want to do is we really, really, really want to find a strong currency to trade against a weak currency. It's like if you imagine, I've said this before, if you imagine you had to bet on two people fighting. Now, this is just a hypothetical example, but if you had to bet on two people fighting, you'd always want to bet on the strongest person against the weakest person, because the strongest person has the most chance of winning, okay? And in a similar way, when we're choosing currency pairs, we want to find a strong currency and pair it with a weak currency. We want to find two currencies that are heading in opposite directions, okay? So what we're going to try to do, each time I come to my desk, I'm always looking at this number one question: which is your strong currency, which is your weak currency? And then I use that to find my bias. Now, some people might rely on technical indicators to do that. I'm relying on fundamental analysis to do this. I'm looking at currency pairs that have a fundamental reason that they will be in a completely different perspective to one another, okay? So we're going to do that today. We're going to look at strong and a weak currency for the European session, and then we'll look at a strong and a weak currency for the American session. And what we'll do is we'll use that principle just to find the currencies that are moving in opposite directions, and we'll use that for ourselves in order to find a currency pair that we think we can know which direction it's going to go in. Okay, so that's the way it's going to go, and we'll get into the guts of the session. So turn to your handout now. Remember, the first way we want to start by looking back, and we're trying to identify recent sentiment. Now, all you have to remember, sentiment is quite simply the current mood of the market. That's all that sentiment is. It's just the current mood of the market. The market, like people, has moods, okay? And those moods change with different, different feelings, different days. But we're trying to find what is the recent mood. And by identifying the recent mood, we can start to identify which those strong and weak currencies are. So here we go. Let's get stuck in. Now, here we are at the Asian session. So when I come to my desk in the morning, I'm coming to my desk at the end of the Asian session, just before the European Open. And so the first thing that I look at is I'm looking at the Asian equity markets, because I want to see what the sentiment is for risk for the coming session. Now, the sentiment at the end of the Asian session was quite mixed. Okay, so we had the Nikkei that was up 0.5%. We had the Hang Seng that was just down 0.23%, and the Shanghai was down 0.11%. So that tells me straight away we have quite a mixed risk sentiment. It's very weak, and it's kind of in the balance. I've said before, you're looking for, when figures are about plus 1%, that's when you take notice. So you can see the S&P 200, the Australian 200, you can see that's plus 1.2%. We'll come to that in a minute. But the Asian indices here are in that very mixed bag. Now, yesterday, what we had a strong move. We had a strong relief rally, and there was a whole sea of green across the equity markets. The S&P 500 was up, the FTSE was up, the Nikkei was up. And so this is the next session after that relief rally. And what we noted at the time was that relief rally is very fragile. You got to think about it, because there's many more risks in the market for pessimism than there is for optimism. So you think of Brexit, think of Italian political risk. You think of the US-China trade war. There's lots of reasons for risk to turn sour, okay? And because there's lots of reasons for risk to turn sour, that's why we know this risk sentiment is very fragile. So yesterday, I was noting in the Telegram channel that we could potentially look at some euro yen longs. I was saying that we were looking yesterday, the sentiment was okay, but the point was it was very fragile sentiment. In other words, it was going to changing very quickly. So this is just confirming how fragile the sentiment is. It wasn't like another strong up day. That relief rally has been very, very tentative. So that's the first lesson that we're learning, and the fact that although there was a relief rally, it's very fragile. So that stands to reason. In other words, we're expecting some bad news to come out at any moment, and the yen and the Swiss franc to strengthen. Okay. Now, of course, the US-China trade war, that's rolling on. It's constantly in the background. I've said it before, I've said it again. US, China, between the two of them, 40% of the whole world's GDP is made up of China and US trade. So if China and US aren't getting on well together and there's trade tensions between them, that filters through to the whole world. And that's some of the big global growth narrative problems we've been seeing recently, haven't we? We've seen a slowdown in Europe, the German manufacturing. We've seen concerns about a slowdown across the whole world from US and China. So that's the global growth narrative, and it's between these two countries. So the question that I want to ask you in this workshop is this, is why do FX traders care about the equity markets? Okay. Why do we as FX traders want to know what's happening in the equity markets? What's the reasoning for that? See if any of you guys here can let me know. What is it? Why do FX traders care about the equity markets? Yeah, there is a correlation, Sammy. Do you know what? Can you be more specific? Yes, Olufemi. Yeah, well done. Sammy Olufemi, you got it. Because equity investors are very sensitive to risk. So when an equity investor is feeling risk averse, money withdraws from the equity markets and will go into the bond markets. Okay. Bond markets offer a more secure return. So if an equity investor is worried about the future state of the economy or of a country, it withdraws money from those equity markets. So when we see a falling equity market, we know that the global economy is feeling risk off. Okay, so that's what we're trying to find. So a falling equity market equals risk off, and a rising equity market equals risk on. Now, in a risk off market, what currency pairs, in a risk off market, what currencies are we expecting to be bought? I'll say it again. In a risk-off market, what currencies? Yeah, Ifam, Olufemi, excellent. Well done. In a falling equity market, we're expecting a risk-off sentiment, and that is yen strength and Swiss franc strength. Okay, so we're expecting those two currencies to appreciate. Conversely, we're expecting the Australian dollar, the New Zealand dollar to depreciate. Okay. So in a rising equity market, when it's risk on, what we're expecting to see is yen and Swiss franc weakness and Australian dollar and New Zealand dollar strength. So yeah, well done, Sammy, that's right. So when you put that together, you're looking at the equity markets to get a handle on risk. And remember, we're trying to find this strong, weak currency pair, okay? So if we are in a really strong risk-off market, we know we're going to have a strong yen or a strong Swiss franc. Okay. So it can help us give a clue. It can give us a helpful clue, okay, for where we want to be going. and it gives us a helpful clue as to which currencies we'll be doing. Okay. So in the Asian session, the main event was the Reserve Bank of Australia minutes. Okay. And the main situation that we've currently got with the Reserve Bank of Australia at the moment is, will they cut interest rates further? Where are they in their sort of cutting emphasis? We know that the RBA had a series of 2 back-to-back rate cuts. And the question now is, will that be carrying on, or are they going to be more neutral? So the minutes out from last night were really, really key. Okay, so we're just going to quickly turn to those minutes now. I'm just going to put up a page here. I'll just search Reserve Bank of Australia. And there we've got the minutes. And you can read through the minutes there. Now, we won't read through all the minutes, but if you want to read through yourself later, I'll just send a link to folks, okay? Just there's a link there for everyone, okay? But looking at the minutes as a whole, what you saw was a general more optimistic view. I just looked at the end. You know, the end was like members would consider a further easing of monetary policy if the accumulation of additional evidence suggested this was needed to support sustainable growth in the economy and the achievement of the inflation target over time. Okay, so in other words, the bank is saying, yeah, we will consider further easing, but only if it's needed to support sustainable growth and the achievement of inflation over time. And if you go, you know, go to a calendar, and you look at the calendar here, and let's just change this to this month, and let's just filter everything out and just put Australian dollar. Okay, and you can just look, you know, look at what the data's been since the last rate decision from the RBA. Retail sales have been stronger. We had the cash rate decision stayed on hold. We've had wage price index up. We had strong employment numbers up, 41.1 thousand, and there was a lot of full-time employment numbers. Unemployment rate stayed the same, okay? And then at the end of last month, we had inflation. It was inflation for Australia. CPI inflation ticked up 0.6%. So when you take that as a whole, that's pretty robust data out for the Australian dollar. So, you know, this hasn't been a surprise. A number of, you know, analysts have been saying that the Reserve Bank of Australia is probably doing a little bit better than it kind of has been. The RBA itself has been fearing, and there was risks that the RBA is better. And you know, the end result of those minutes was, you know, the chance of a rate cut is now seen at 12% at the next meeting versus 50% of a rate cut a week ago. Okay, so that was how the market reacted to the minutes. They now see that the RBA is less likely to cut rates, and it's much more likely to be at a holding bias for the next rate meeting. So that means that less chance of a rate cut. It means the Australian dollar will, well, what would you expect this to do for the Australian dollar? Given this context that the RBA minutes were important, given the fact that questions were being asked about the Reserve Bank of Australia, you know, Have they been a little bit too dovish? Were they going to be switching to a more neutral stance? And now the minutes have come out. The market has spoken and said that the chance of rate cut is now 12% versus 50% a week ago. What would you expect this to do to the Australian dollar? Would you expect? Yeah, that's right, Sammy, exactly. You'd expect the Australian dollar to rise. Okay, so this is a sentiment shift. Okay, expecting rising Australian dollar. So looking at the end of the Asian session, thinking to myself, which is the weak currency, which is the strong currency? So the strong currency for me was the Australian dollar. We've had that sentiment shift. The chance of a rate cut are now 50%, are now gone down from 50% to 12%. Okay, there's more optimistic reasons for the Australia's economy. Strong currency is the Australian dollar. Okay, a weak currency is the New Zealand dollar. Now, for those of you who have been following this for some time, you will know that I've been talking about the divergence between the Reserve Bank of Australia and the Reserve Bank of New Zealand. So the Reserve Bank of New Zealand is in a different situation than the Reserve Bank of Australia. Governor Orr has cut interest rates, and Governor Orr's cut interest rates by 50% at the last rate cut meeting, and the RBNZ have said they would consider negative interest rates. They will also consider quantitative easing. So when you compare the Bank of New Zealand and the Bank of Australia, the Reserve Bank of New Zealand is much weaker. So in comparison, you have the strong currency Australian dollar, weak currency New Zealand dollar. Okay, so now once we've done that, what we want to do, we want to now look at the chart. Okay, because we've got our weak currency, we've got our strong currency. We know there's a bias between these two that are different. Okay, and we know that these two currencies should be going in opposite direction. Okay, so let's have a little look here. Let's get a chart up. So here's a chart. So now we've got Australian New Zealand dollar currency pair. We can see that the Australian dollar has been appreciating against the New Zealand dollar overnight. Okay. So what we're looking at here is where is a good place to join a short term, where can we expect buyers to come in from on this currency pair? Okay, so we're on the 15-minute chart, we're on an intraday chart. Let's start putting some interesting levels on. So we want to start looking now. Where's a good pivot point? Okay, we've got a pivot point down here, and we've got a pivot point up there. So that's a couple of interesting pivot points. Look on the hourly chart, got one above. So we've got some resistance up ahead. Well, that's helpful for us. We know we've got a resistance level up here. Now, let's take the pivots off. Now let's look where else we got. We got the 100 exponential moving average and the 200 exponential moving average. Let's put in some horizontal support and resistance. Put a horizontal line in there. So let's draw a line. We've got some horizontal support here, here, and we've also got some horizontal support here. Okay, that's quite an interesting line there. Let's make that a little bit thicker. Line, visibility, coordinate, style. I'll leave it like that for now. So we've got a line there. Now let's put a Fibonacci retracement level on. Going from the lows to the highs. Yeah, okay. Well, we've got a level that really stands out there, and the level that really stands out there is this 1.0562 level. Okay, so 1.0562, we have some horizontal support, and we have the 50% retracement of this entire move level. Okay, so we could reasonably expect buyers at this level. Okay, so I would expect to find buyers here. I'd expect to find stops down below here, and then obvious targets will be back up to these highs, back up to that resistance level 1.05 1.0573. So that would be, you know, from 6.1 to 7.5, sort of taking 14 points out of the market there. That is, again, not trading advice, but that is something that I expect to hold. Now, the issue that might change here, what would be the risk? You always want to look, what's the risks to this trade? Well, the risks to this trade would be if there's some really negative US-China trade news. And the reason that would be negative is because the Australian dollar is sold off heavily on US-China, you know, trade concerns. So the Australian dollar sells off more quickly than the New Zealand dollar. So that's something just to be aware of, okay? So that's the risk of the trade. So, you know, you want to be, with these intraday trades, you want to be kind of around, and you want to be looking out for that any US-China trade news. And if you get, you know, some bad US-China trade news, then, you know, you don't have to wait for your stops to be hit. You can just pull the trade, okay? So that's, you know, one scenario that I've been looking at there. And this would be, yeah, 1.0561, 1.0564. So anywhere from about 10564 would be a sensible place where I expect buyers to return into the market. Okay. Right, okay, let's just move that chart out of the way. Just drag it off for now. Just pop it there for now. Okay, so that's what we've done in the Asia session. Now, in the European session, we have a low data front. So looking at the European session, it was quite simple for me. I just favour a continuation of the Australian and New Zealand dollar outlook. Of course, I'm looking for any fresh sentiment changes. So anything that is new or any developments, and there's so many different developments at the moment, either Brexit, the Italian political risk, US China trade war. There's a number of different things that could just come into the market. Okay. So in the mid-morning session, we looked at it, and remember, we're kind of in that kind of indifferent place, that kind of middle ground where the markets weren't going one way or the other. Okay. And we saw, look, in Europe, we saw some of the equity markets were in the green. The DAX was down. The Portuguese IBEX was down 0.25%, Italian FTSE down 0.35%, but, you know, the Portuguese 20 was up, the French 40 was up, Euro stocks were up, and the FTSE 100 was up. So mixed situation. Bond yields, again, like what we're looking at with bond yields is when yields are falling, that's negative for a country, okay? When yields are rising, that's positive for a currency. But there's an exception, and the exception is that if yields are rising, it can be a sign of market panic or concern. So here's a good example, and it's a great learning point. We can see, look, all the European bonds yields are down, okay? So that's negative for the euro, negative for the pound. There's a generally negative outlook. But look, the Italian 10-year bond is up, plus 2.99%. You can see it alone is up. Now, one of the reasons that bond yields can sometimes go up in a time of crisis for a current country is quite logical when you think about it. You know, if you want people to lend you money, you can offer more of a return. So with people concerned about Italian bonds, the Italian yields are increasing to incentivize investors in order to invest their money in a riskier asset. That is essentially what's happening. So that's why, even though the euro was pressured, we had the 10-year yields going up. But that's the exception to the rule. The general rule is when you've got yields falling, it's negative for a currency. When you've got yields rising, it's positive for a currency. That's a key thing to look at, and that's why FX traders are often, you know, always looking at what's happening with the 10-year yield, the 5-year yield. You'll often hear it reported, you know, and that's why because the relationship to currencies and to risk. So that was happening in European mid-morning session. We'll have a quick look now, just for our education, because it's good to get these relationships straight in our head. So this is a snapshot of the markets right now. So we got the S&P 500 down 0.16%. So that's negative. We got the volatility index is flat, Nasdaq is flat, Dow is flattish. So there's just getting Dow futures 0.13%. So a slight negative sentiment into the US equity open. European indices. Look, we've got equity markets down across the board. The Italian FTSE down 1.18%. We know there's Italian political risk today, so that's why Italy's getting hit particularly hard. We had the S&P, the Australian 200, closed up 0.12%, and that's obviously on the optimism out of the RBA, so that gave some boost to the Australian indices. And yields of the 2, 5, 10, 30-year yields are all down. Okay, so we can see we're in a sort of neutral to risk-off environment. We're moving much more closely to a risk-off environment. We've got the Italian Prime Minister, who is now appearing before the Senate today at 2 British summertime. So that is political risk that is currently going on, and that risk is going on for the euro. So just to be aware of that, you don't necessarily want to be jumping into any euro trades at the moment until we find out how this is resolved. And you can take a screenshot of this. You can, look at this in your own time. But the bottom line is that ING basically believe that elections are going to be the most likely option of Italian PM appearing before the Senate today. And the possibility of new elections and the threat of an extended period of political uncertainty continues to hint at downside risk to the euro, alongside the possible dampening effects of the ECB's easing package to be delivered in September, it said. So, it's just saying it's a bearish picture for the euro. We've got the ECB expected to maybe cut interest rates by more than 10 basis points, entering a tiered deposit system. Ollie Rehn, the ECB speaker, came out last week saying that it's better that the ECB do too much rather than too little. So we're getting this really bearish picture for the euro. So, one other currency pair that does stand out is the euro Australian dollar, because look, you've got this strong Australian dollar sentiment on the RBA minutes, and we've got this weakness in the euro. So you can see here, looking at these, looking at places to go short, you can see that this 200 exponential moving average with the pivot point there, you expect sellers here. You could expect sellers up there. You could also expect, if you draw a fib retracement level, you'd expect sellers again here. Look at this. This would be another really key place here. So you got that. You got the support here, 200 exponential moving average on the 15-minute chart, and that horizontal level there. So you could expect sellers here down to that. Now, the reason I didn't take the trade was because of the European political risk. Okay, so if the European political risk wasn't there, that would be, that would not be a bad potential trade. But with that playing out now as I'm on the webinar, until I got some kind of resolution about the situation, I don't want to risk getting into a euro trade. So that's my logic, that's my reasoning, that's my thinking behind that. But I just thought it's worth flagging up because look, the euro is a weak currency. We know that's prolonged weakness. and we know the Australian dollar is growing in strength. So this is where you have the sentiment change. So you have the Euro Australian dollar sentiment change, and can we join that sentiment shift? You know, that's all that's going on there. Okay, so sentiment for the European session: Australian New Zealand dollar expect buyers from support, and then waiting for a fresh driver for the euro. I'm just waiting to see if there's something. You know, this could be an opportunity. It could be opportunity for long or short euro based on what the political risk happens. Okay, so that's to be aware of. Okay, so we've finished looking back. We're now looking forward. Right, looking forward, we can see it's quite a sparse US session. There isn't a lot of key data, so not expecting big movements looking forward. So again, looking for fresh news, fresh sentiment, anything on the squawk or anything that comes across the feed. Now, looking forward, there is a very interesting event that's coming up, and this is the Canadian CPI data. And this is just a good reminder that as FX traders, our job is to make money, it's not to trade. So it may be, you know, you're not in a trade at the moment. That's fine. You don't need to force it. You don't need to find a trade. You don't need to make a trade, because trades come along. And here's a potential trade that's coming along that I'm eyeing up, quite interested in. Tomorrow, 1:30 my time, which is summertime, it's the CPI data out of Canada. Now, this is when you've got to know the story. The market at the moment with the Bank of Canada, the Bank of Canada is the only central bank that has not become explicitly dovish. I said the only major central bank. Okay, there are other banks, but the only major central bank that hasn't turned dovish is the Bank of Canada. So the question is, the market's expecting the Bank of Canada only to be a question of time before it does turn dovish. So we now know we've got this expectation. The market is waiting for the Bank of Canada to turn dovish. It's just waiting for the reason. It's waiting for the excuse. You know, it's waiting for that a reason to go. Okay. Now, the CPI data tomorrow could potentially that reason. So say we get a miss on that data. Say you get minus 0.1%, minus 0.2%, something like that. Then the market's going, aha, this is all we needed to know. This is confirmation now for us that the Bank of Canada will definitely turn dovish, and the CAD will be sold off heavily. Okay, so what we're looking for is, apologies for you, we're looking for the sentiment and the data to match. Okay, so if the sentiment is saying we're waiting for Bank of Canada to turn negative, as soon as the market gets that reason, you're going to see the Canadian dollar sell off. Right now. The question is which currency pair to trade it with and against. So we're looking, if the Canadian dollar turns weak, what would be potentially strong? Well, we've had potentially strong sentiment from the Australian dollar today. So an Australian dollar CAD pairing might make sense. And that's really what we're looking for. That's the main one. We're looking for a miss on this number. That's where the main opportunity resides, you know, and that one opportunity in the week could be all the trading that you need to do for the whole week. Could be just this one opportunity. So that's why it's important to try to not lose money taking substandard trades or just getting into the market and then pulling your position and the death of 1,000 cuts. So that's why it's important to wait for these big, clear opportunities like we potentially got tomorrow. So that's one to be looking at. Okay, obviously got the FOMC meeting minutes as well, and the big story with the Fed is, are they going to be dovish or bullish? There's a lot of pressure on the Federal Reserve from Donald Trump to maintain a dovish bias, but the US data has been pretty robust. So which way is the Fed going to go? And then there's the FOMC meeting minutes will be eyed, but also the Jackson Hole Symposium will be eyed this week. So expect a little bit of uncertainty about the US dollar until we start getting some clarity from the Jackson Hole Symposium. Okay, that's when we're going to start to get some more movement, most likely, on the dollar. Thursday, looking ahead, we've got flash manufacturing and services PMI out of Germany. Germany is the largest Eurozone country, so it has a big impact on the euro, and it's been the slowdown in German manufacturing that's really prompted big concerns about the euro. And you know, Germany have been expressing some of their concerns about the slowdown in Germany as a whole. And so the market's been looking for this. Is the manufacturing PMI getting worse? We know it's expected to be as bad as before. And you know, will that start moving into the flash services? If manufacturing weakness goes and starts pushing into the services, then we're going to see most likely more downside on the euro. And you know, the worse this number is, the more the expectation that the ECB is going to have a higher move of packages come September. So that's just something to be, you know, aware of going into Thursday. Okay, so you know, a good one to look at. And again, so if you get a weak currency bias, we want to trade it with a strong currency. So if you get risk-off sentiment, you know, again, a euro yen would be making sense again. Okay. So just saying, the Jackson Hole Symposium, we covered that. That sets the near-term direction of the dollar. Now, will the Fed indicate that aggressive rates are ahead? That's going to be dovish US dollar. Will the Fed indicate a more neutral stance? That's going to be bullish for the US dollar. Just also worth making it clear that the near-term path for gold is to swing around the Jackson Hole Symposium too. Now, the gold future markets, this is a indication of gold future positions. So gold future positioning has just clipped recently above 45%. Okay. And this is mainly hedge funds that have been putting a lot of longs into gold. You know, we've covered it a number of times what the attraction is for gold. There is quite a lot of attraction for gold at the moment. You know, the attraction is there's low yields in the rest of the world. So if with such low yields in the rest of the world, then gold is having its reputation as a store of value, despite having no yield, is coming back in, right? Now, the only problem is, at the moment, we've got a lot of long positions. So the problem is, when lots and lots and lots of people are long, it's hard for the price to keep rising and keep going up. Okay, that's just a market kind of fact. Okay, so with that being the case, the future path of gold, I'm looking at the Jackson Hole Symposium to kind of give this lead on gold. If we get a dovish Fed, I'm expecting that to be bullish for gold. Okay, because if the Fed is dovish, then we know we're going to see US dollar weakness, so we're going to see gold strength. If the Fed is going to be more bullish, then that's obviously going to be bearish for gold. And gold's near-term direction is going to be decided by this Jackson Hole Symposium for now. And just remembering that, each time, 2011, 2016, 2017, each time that the number of future contracts got above 45%, each time that happened, prices sold off. Those levels have just pulled back from those levels. So we could be in for a pullback. So just to be careful that if we get a bullish Federal Reserve, or they're more neutral, then look for a pullback and expect gold to pull back. Obviously, you get a very dovish Fed, then we'd expect some more upside in gold. But just wanted you guys to be aware that we're reaching some quite extreme positioning for gold. Now, I still think gold is going up, medium to longer term, as long as there's a low yielding environment. Okay, as long as that's the case, then I can see that gold will be supported. However, this is just for the near term. At the right now, that we're at a potential point of a potential deeper pullback. Okay, that's basically what I'm saying. And obviously the Fed will determine that, and will give us a sense of which, will give us more of a sense of that going forward. So that's just something for you guys to be aware of. Okay. Here's some free resource to work out sentiment by yourself. I've obviously got the handout that you guys can use. As well as the handout, here are some key resources that you can look at. You can try to get there's another one here, Action Forex. I'm just going to type one in. This is another site that offers a session wrap. I'll show you as well here. Let me show you. I'll show you here on. Yeah, okay. So if you go to forexlive.com, I write for these guys daily, and there's a great bunch of analysts here. If you go to trading session wraps here, right, you get little wraps on what's been happening in each market session. So if you look here, you can see this is a summary of what's happening. Eamon's been writing about this, and he's also given the, a summary of the session. Look, the Australian dollar was the mover during the session today, albeit in a small range, not as small as others though. There was nothing surprising in the minutes. The RBA has an easing bias and now remains in monitoring mode. The Australian dollar has fallen. Okay, so you can go that, and you can go to, on the RBA minutes, and you can look at the minutes yourself, and you'll get some analysis there, which you'll genuinely find helpful. Okay, so that is a good resource that's just out there. There's others as well, a number of different websites that you can use to tune into this sentiment. Okay. Again, you can take a screenshot of this. This is the intermarket correlation. Again, it's pretty helpful. When you've got a lower volatility index, you've got stocks rallying, commodities rising, bond prices falling, yields rising, you get risk on and FX trades. And risk on, you've got yen, Swiss franc weakness, you've got Australian dollar and New Zealand dollar strength, right? When the volatility index is higher, then you've got falling stocks, falling commodities, you've got bond prices rising, which results in yields falling. That's when you've got risk off. So when you risk off in FX trades, you've got yen, Swiss franc strength, and Australian dollar, New Zealand dollar weakness. Okay, so that is nice little intermarket correlation. Just work on that, getting that down, because yeah, okay, equity and bond markets. Olufemi, you can find that here on TradingView. And also check. Yeah, okay. Yeah, and you can also find it on and have a look, have a Google to find a good site. And if anyone knows a really good site for bond prices, bond yields, for equities indices, just let us know in the comments section, and I can let everyone else know. Because all the pricing that I get is it's paid feeds. Because the other thing is you can a RAND Squawk service is quite good. So if you have the resources, a RAND Squawk service will give you access to a squawk where they tell you what's happening, what's going on, what moods the market in, what the equity market's doing, and they actually even squawk it out. So that's just something to be aware of as well. And we'll look at the importance of trading fresh sentiment when trading. Now, when we're trading fresh sentiment, what we want to do, we want to be zoning in on what's been moving the market recently. So, for example, what have we seen that's been moving the market recently? Well, what we've seen is we've seen the Reserve Bank of Australia. We've seen the minutes that are out being more they're more optimistic. So once we know the narrative of the market, we want to find if there's any more news that supports that, we're going to see more strength. Okay, we're going to see more Australian dollar strength. So say like in the week you get Governor Lowe speaking, or say something suddenly comes across the feed where Governor Lowe suddenly says, we will now turn to a more neutral bias, or we're going to be turning neutral to bullish. We're going to be looking at not only holding interest rates, we're now looking at raising interest rates the first half of 2020. If you've got something like that, that's that fresh sentiment shift. And you're going to get two opportunities for a trade from that. You're going to get the initial spike, which you can just jump in on because the news is so obviously good. And then you can get the second phase, which is a 50% retracement of that initial move. Okay. So that is what you're looking at, okay? Those fresh sentiment changes, look for what the market is zoning in on, look for what the market is focusing on, and by getting the market's focus, you then are in at the right point, okay? So you've got to keep focusing in to what that key market sentiment is. But try to get the fresh sentiment. Remember, the more something is known, the less impact it has. So once sentiment has got old, it no longer has the same impact. So you've usually got a window of about 24 to 48 hours of when you can trade sentiment, okay? That fresh sentiment change, that new data point or that surprise move. So for example, now with the Australian New Zealand dollar pair, okay, got that slight shift from the Reserve Bank of Australia. So I've got like 24, 36 hours for a retrace to happen. If it hasn't happened in that time, then I'll be just scrapping my orders, for instance. So with the sentiment, you want to have about 24 hours, 48 hours, but using that fresh sentiment is a really it's some of the best, most reliable trades come from that fresh sentiment change. Okay, that's really what you look at. You want to look for that fresh change. And how do you know it's fresh? Well, often you'll have the news that will come out, and at the same time as the news comes out, you'll see a strong move in the currency. Okay, that gives you a clue. Okay, now if you trade part-time and say you missed that first move, don't worry, because all you do is you do like what happened today. You go back into your feed, you go read your report, and you would have read, okay, the Australian dollar. Okay, right, here you go. We read the Australian dollar. Okay, has been bid on a basically a more upbeat RBA. Okay, and the market has, I think, less chance of rate cuts. Okay, so I missed that move down here. Now you don't want to just jump in the market here and just say, oh, I'm in the market. No. You don't want to just jump in there. Instead, you're looking for those retracements. So you get your first opportunity there. And if you miss that, you get your second opportunity, just say like the 50% retracement. Okay. And then you're looking to take your trade from there and then just take your profit off down at the bottom here. Okay. And then that is, you've got your money, you've made your pips, okay, and you've completed your trade, and you've got your money, and you walk away, and you can sleep at night, okay. So you can, as you get more experienced, you'll know when you can hold your trade and when not to hold your trade, etc., okay. But for now, getting those fresh sentiment changes, You see, I would give this, for 24, 48 hours. So, by tomorrow morning, maybe it's coming back up here, might be worth it, maybe not. You got to make a judgment call. But for now, you can see, look, price try to get that first retrace up to the 50%, and then taking profit down at these lows here. Okay, those recent lows, 1.6326, 1.6327. That would be a sensible place just to take your profits. Okay, but you've got to get into the habit of recognizing the weak and the strong currency pairs. It takes time. Okay, so you want to be making sure you're demo trading. Just get 2, 3, 4, 5 months consistent profitable trading, and then you use your real account. You just, when you got it down, you know what you're doing. Okay, you could have done exactly the same with the Australian dollar, New Zealand dollar pair. But you see there, that's how you put it together. That's how you work it. And you just want to keep that working. Okay, so like now on the feed, you've got Italian Prime Minister Conte says he will resign. So you've got this sudden bit of news. Italian Prime Minister Conte says he's going to resign. So you're looking at the euro. What's that going to do with the euro? Having a little look at it now, you can see it's down some points. Not a massive move at the moment, but that's the kind of thing, the kind of the fresh sentiment you're looking at. And seeing a sentiment like that, okay, that means it's more likely to be a general election, which means more uncertainty for the euro, which means probably more downside for the euro. So that's the kind of situation that you're looking at. Okay, so yeah, so there's now a series of events that's going to take place, and if those events fail, then there could be a general election in October or November. I'm going to leave that now because I don't want to be getting into that now as we close up the markets. But it just goes to show and serves the point a little bit. So okay, guys, I hope that's been helpful. Don't forget to keep practicing what I've been saying. Don't forget that HYCM do this offer here, and this offer is they offer one-to-one coaching with myself for different amounts that get deposited in your trading account. So if you deposit these amounts into your trading account, then you get the following benefits. Some people found this helpful that I've done this with. It can just help to be answering specific questions, giving people some specific guidance on the issues. If you guys have got any question, you're welcome on Olafemi. Any questions that any of you guys have got on here? Okay, that's good. Well, guys, I hope you have a really good week, and don't forget that Canadian CPI data out on Wednesday. That's quite an interesting event that you don't want to miss. And obviously the Jackson Hole Symposium coming up towards the end of the week will be deciding some of the path of the dollar, and along with the dollar we'll be looking at the price of gold as well. Okay, guys, have a great week. Thanks for coming, and I look forward to speaking to you soon. Thanks now. Goodbye.